The next category of asset management ratios we want to take a look at are the receivables ratios. So if the inventory ratios tell us something about how efficiently or how quickly we're turning over our inventory, then the receivables ratios are going to tell us the same kind of thing about how we're using our receivables. How is our credit policy impacting our sales? So we have similar measures. We have a receivables turnover measure, sales divided by accounts receivable, and then we have days sales in receivables. So on the receivables turnover, we take sales divided by accounts receivable. So we just pull those numbers off the income statement and the balance sheet, and we see that we have about 12.3 times our sales in receivables. Now this is important because it gives us an idea about the relative proportion of credit sales to cash sales that we're undertaking. For example, if receivables turnover were 1, then we would have all of our sales being made on credit. If receivables turnover were 2, then half of our sales would be being made on credit. So receivables turnover tells us something about the proportion of receivables to our total sales. The days sales and receivables number is 365 divided by receivables turnover. Again, 365 days in a year. And that tells us about how long in days it would take us to collect on our credit sales. In this case, 365 divided by 12.3 is 30 days. And if you think about how often or how long we have to pay our bills, 30 days is usually a reasonable period of time. So it seems like our credit usage here is pretty good. We have a lot of sales relative to our receivables on the receivables turnover ratio, and we have a relatively small number of days in our days sales and receivables. The third group of asset management ratios are our payables ratios. Now again, these are going to be relative to our accounts payable, and they're going to be very similar to our accounts receivable. Instead of using sales, we use cost of goods sold, because cost of goods sold is our cost of the materials that we purchased or the inventory that we purchased. And we're going to divide that by accounts payable. So again, we pull those numbers off the income statement and the balance sheet, and we have about 3.9 times our cost of goods sold divided by accounts payable. Again, this is one of those measures that tells us what proportion of our cost is being financed with credit. Remember that accounts payable is sort of when we purchase our inputs on credit, and the same kind of thinking can go here as with receivables turnover. We kind of like a little bit larger number because that says we don't have to rely quite as much on the accounts payable to finance what's going on in the firm. We can also put that on days cost and payable on a days basis, and you see that we would be able to, that we could cover that in about 94 days. The last group of asset management ratios are the asset turnover ratios, and that tells us something about our total asset turnover usage. So the total asset turnover ratio is sales divided by total assets, and you see that we compute that number is 0.64. So if we think about it in terms of dollars of sales per $1 of total assets, each dollar of total assets that the firm owns is generating about 64 cents of sales per period. If we invert that number, we get the capital intensity ratio, which tells us how many dollars of total assets we have per $1 of sales, and that gives us $1.56 of total assets per $1 of sales. Now that doesn't mean a whole lot right now to us, but if we have some points of comparison, which we will in the future, then the capital intensity ratio and the total asset turnover ratio do make sense. So on the asset management or the turnover ratios, what we want to remember is that these are measuring most of the items on the asset side of the balance sheet. What kind of job is our management doing at handling our accounts receivable, our inventory, and our fixed assets or our total assets? The next set of ratios that we'd like to look at are the profitability measures. And there are three that we're going to use relatively consistently. The first is the profit margin, which is also known as the net profit margin. It's called the net profit margin because it uses net profit or net income. The net profit margin definition is net income divided by sales. So both of those numbers come from the income statement. So we'd simply pull 363 divided by 2311 and we get 15.7%. Now what that means is that out of every dollar of sales, we're keeping 15.7 cents of profit. I don't know if that's good or bad because I don't really have a point of comparison at the moment, but we can use that measure to measure our profitability. The second measure is return on assets. And return on assets and the third measure, which is return on equity, are similar. The difference is that return on assets uses as the denominator total assets, whereas return on equity uses total equity. So I want to have everybody think for a minute about what is the balance sheet definition of total assets. The balance sheet definition based on the balance sheet identity is total assets equals total liabilities plus total equity. So we could really look at return on assets as net income divided by the sum of total liabilities plus total equity. So in other words, return on assets is comparing profit to all of our financing, total liabilities plus total equity. Whereas return on equity is comparing profit to just total equity. So the difference in the two measures, ROA and ROE, are that ROA includes all of our sources of financing, whereas ROE only includes the equity source. Now again, we can pull those numbers off the balance sheet and the income statement, and we can compute those numbers, but we're really not going to have a point of comparison until we have some other data to work with here. We can look at, finally, some measures that compare our firm's operations to the market value of our stock. We remember that the market value of the stock is really important when it comes to what the manager's job is. The financial manager's goal is to maximize the value of shareholders' wealth, of existing shareholders' wealth. So $88 per share, that's the market price currently. And we also know that we have 33 million shares outstanding. So if we wanted to calculate some measures, we would look at some things like earnings per share. Now, earnings per share, the definition is net income divided by the number of shares. So if you rewind to the income statement, you'll see that we have $363 million of net income, and we have 33 million shares. So that means that our profit per share, or our earnings per share, is $11 per share. Most of you have probably heard of the PE ratio. The PE ratio gives us a measure of what the price of the stock is relative to the earning power of the stock. So we take the $88 price per share and divide by the $11 earnings per share, and the ratio turns out to be 8, which means that we would pay $8 of price to get $1 of earnings. Now you can think about how we would use the PE ratio to compare two different stocks. If we knew the PE ratio for one company was 10 and the PE ratio for the other company was 8, then that says I'm paying $10 to get $1 of earnings, or I'm paying $8 to get $1 of earnings. In either case, we're getting $1 of earnings, so why not pay the lower price? So historically, what we think is that companies that have the best growth potential and are the best investments have the lower PE ratios, because that means they are cheaper and a better value. We could calculate the price to sales ratio. So just like the price to earnings ratio, the PE ratio compares the market price to the earnings per share. The price to sales ratio compares the price per share to the sales per share. So we'd have to go to our income statement and look up the sales, divide by the 33 million shares, and then divide that into our $88 price, and we would get a comparison of how much would we pay to get $1 of sales. A third measure that we could use is the market to book ratio, which is also called the price to book ratio. The price to book ratio, or the market to book ratio, is the price per share divided by the book value per share. And you see here on the slide that the book value per share is defined as the total equity divided by the number of shares outstanding. So the book value per share is the accounting value of equity per share. So the market to book ratio of 88 divided by 78.52, the 88 is what the market says the stock is worth. The 78.52 is what our accountants say the stock is worth on the books. And we can get a comparison there of what are those two different measures of value giving us. We could also calculate the enterprise value of the firm. The enterprise value of the firm is a very important measure because it includes all the market value of the stock plus the book value of all the liabilities minus the cash that we have to pay off. So the enterprise value would be what our creditors and our owners own in terms of financing after we adjust for cash. So you can see that we have $88 per share multiplied by 33 million shares. We have $35.88 of total assets minus $25.91 of stockholders' equity. That gives us our liabilities in the second set of parentheses, and then the cash is in the third. So the first set of parentheses is the value of the stock. The second set of parentheses is the value of the debt. And the third set of parentheses is the cash that's available. And that's 3803 is the enterprise value. The EBITDA ratio is the enterprise value divided by earnings before interest, taxes, depreciation, and amortization. In order to calculate EBITDA, we take EBIT and add back depreciation and amortization. In this case, we just have depreciation. So we have our EBITDA ratio of 3.93 times, which is a measure of course, the value of the firm to our operating income. So here's a recap of the Prufrock ratios that we've just discussed. And you can see for this particular year, we have a lot of information that we can use. As I've mentioned a couple of times through these comments on this video, we don't have any points of comparison though. We just have one number. So, for example, the current ratio is 1.31. Well, is that good? Well, we sort of know what good is because we want it to be bigger than 1, but we don't know if that number is improving or getting worse, and we don't know how we stack up against our competitors. So one of the things we're going to have to focus on is our context in which we interpret these ratios.